All right, let's get right into this because what's happening with Rezolve AI is an absolute street fight. The U.S. markets are closed for the weekend, and as of the final bell on Friday, November 7th, 2025, Rezolve AI, ticker RZAI, ended the session at $3.83. That was a deceptively quiet close, down just 2 cents, or 0.52%. After hours, it ticked up a tiny bit to $3.87. Now, the expectation for anyone looking at this, a sub-$4 stock that's been obliterated from its 52-week highs, is that this is a dead company. The common belief is that this is a fraudulent, cash-burning, Me Too AI company that got annihilated by a short seller report. And on the surface, the chart screams danger. But that quiet $3.83 price tag is the most misleading thing you will see all day. The reality is that this stock is not dead. It is a coiled spring. It is the epicenter of one of the most violent collisions between a short seller narrative and a massive, fundamentals-driven bull thesis I have ever seen. What you're seeing isn't the stock's death rattle, it's the quiet before a war. While retail traders on the Robinhood app are looking at the scary chart, institutional investors at Fidelity are looking at the press releases from this week and are placing their bets. This is the definition of expectation versus reality. Let's start with the expectation, the bear case, because it is terrifying, and it's what's keeping the stock price pinned at $3.83. On September 29th, a short seller, Fuzzy Panda Research, dropped a bombshell report. They allege that Rezolve is faking its annual recurring revenue, or ARR, by just acquiring failing startups. They claim the company is lying about its AI capabilities and is really just a tired old mobile tech company in a new AI costume. This report was devastating. The stock collapsed over 16% in 2 days. To make matters worse, on October 28th, the Pomerantz law firm announced it was officially investigating the company for securities fraud based on that short report. You could not invent a more perfect collection of red flags. This is the kind of news that sends self-investing clients running for the hills, and it's why the stock is trading for less than a cup of coffee. That is the expectation. It's a compelling story of fraud and failure. Now here is the reality, and I want you to listen very closely because the company's response has been an absolute blitzkrieg. This is the bull thesis. First, let's talk about the business. The short report says it's not real AI. The company's entire focus is on something called agentic commerce. This is the idea of using autonomous AI agents to handle the entire e-commerce process, from discovery to purchase. The expectation is that this is a made-up buzzword. The reality? On November 4th, this past week, Rezolve put out a press release gleefully pointing out that Amazon's own CEO, Andy Jassy, in his quarterly call, just called agentic commerce the undeniable future of e-commerce. This is a staggering validation of their entire business model from the most important e-commerce company on the planet. Rezolve is positioning itself as the first mover, the pure play on the very technology that Amazon CEO just anointed as the future. Second, the short report claims they are a failing, cash-burning company. How did Rezolve respond? On November 5th, just 3 days ago, they announced they had just closed an oversubscribed $200 million financing. Let me repeat that. This failing company, which is supposedly a fraud, just had institutional investors fighting to give them $200 million. This single press release incinerates the cash-burning bear thesis. It moves them from a position of weakness to one of absolute power. It's a war chest. And what are they doing with that $200 million? They told us on the same day. They are launching a massive acceleration of their U.S. and European commercial rollout. And to lead this charge, they announced they have hired Elizabeth Lachar, a former Microsoft executive, to be their new Senior Vice President of U.S. Sales starting in January 2026. You don't get a $200 million oversubscribed round, and you don't poach executives from Microsoft if you are a fraud that's faking your technology. This is a big league move that directly contradicts the short seller's narrative. This isn't Robinhood crypto-level speculation. This is a C-suite build-out. Now, let's go back to those failing acquisitions. The bears say they were bought to fake revenue. The company's filings from October show a different story. They bought SmartPay and SubSquid. These aren't random companies. SmartPay provides digital asset payment infrastructure. SubSquid is a decentralized data and blockchain indexing platform. Rezolve is not just buying revenue, it is vertically integrating. It is buying the foundational data and payment layers it needs to build the agentic commerce engine it's telling the world about. It's a strategic, long-term infrastructure build, not a short-term accounting trick. But the most stunning disconnect, the part that has interactive brokers and SoFi Invest platforms buzzing, is the actual financial data. The short report wants you to ignore the numbers. Let's look at the numbers. On October 1st, Rezolve reported its first half 2025 results. Revenue was $6.3 million, up 426% year over year and beating the 5.1 million analyst consensus. Okay, that's impressive, but this is the number that matters. Their gross margin was 95.8%. That is not a typo. 95.8%. That is an elite, top-tier, best-in-class SaaS margin. That is the opposite of a failing company. That is the sign of an incredibly valuable, scalable, and proprietary technology platform. And they didn't stop there. In that same report, the company, in a direct show of force against the short sellers, raised its full-year 2025 annual recurring revenue guidance to a minimum of $150 million exit rate. And then, for good measure, they initiated 2026 guidance for a $500 million ARR exit rate. A company being investigated for fraud does not and cannot guide this aggressively. They are putting their credibility on the line. And who are their customers? The report says they're not real. The company's own filings list over 100 enterprise clients, including H&M, Ferrero, and Urban Outfitters. These are global, blue-chip brands, not shell companies. So, this is the war. The expectation is a $3.83 stock, a fraud, a short seller's dream. The reality is a company with 95.8% gross margins, 426% revenue growth, a $200 million war chest, a new Microsoft executive, and an Amazon CEO validating their business model, and a list of blue-chip customers. So why is the stock still at $3.83? Because of the other piece of news from this week, the prospectus. On November 7th, the company filed a prospectus covering the resale of over 164 million ordinary shares and 7.5 million warrants. This is the dilution that the short sellers warned about. This is the overhang. This is the fear. The market is now trying to absorb this massive new float, which is why the stock is being held down. This brings us to the final piece of the reality puzzle. What do the professionals think? After the short report, after the fraud allegations, analysts on Wall Street didn't run. They didn't downgrade. On October 29th, the analyst consensus price target was raised from $7.90 to $10.79. And the institutional ownership data from that same report showed that in the last quarter, institutions increased their holdings by 442%. 54 new funds, including names like Geode, Northern Trust, and Jane Street, have started new positions. While the retail trader is panic-selling the short report, the smart money at Fidelity Wealth Management and Fidelity Brokerage desks are quietly, aggressively buying the dip. They are buying the 95.8% margins, not the short seller story. Here's a question for everyone watching, and I want you to think about this. Comment below. What is more powerful in 2025, a short seller's report or 95.8% gross margins? Let me know what you believe. Looking forward, this is a binary investment. This is not a slow and steady name for a Schwab Intelligent Portfolios account. This is a high-stakes, high-conviction bet in an individual brokerage account. The bear case is that the short sellers are right. The fraud investigation finds something. The 164 million share overhang crushes the stock. The $500 million ARR guide is a fantasy, and this stock goes to zero. It's a real risk. But the bull case, the one backed by the $200 million in new cash and the 95.8% margins, is that this is the most asymmetric, mispriced opportunity in the entire AI sector. It's a mini Palantir scenario, where a company is attacked and the smart money uses the fear as a once-in-a-generation entry point. In this scenario, the company uses its new cash to execute, hires the sales team, and starts hitting that $150 million and $500 million ARR guide. The stock doesn't just recover, it re-rates violently. Those analysts' $10.79 price targets will look conservative. So, to summarize, that flat $3.83 close on Friday with 9.7 million shares traded is the sound of a battlefield. The expectation is that this is a dead stock, a victim of a short seller. The reality is that this company is armed with $200 million in new cash, is hiring Microsoft executives, has Amazon CEO